Hey, what is up, everybody? Welcome back to another episode of Going Deep with Aaron Watson. I've got a great interview for you here today. Andy Rachleff, the CEO and founder of Wealthfront. Wealthfront is one of the new robo-advisors that has sprung up in the last few years and is rushing to fill the space of providing reliable, valuable investment advice for a fraction of the cost of financial advisors and wealth managers at larger, older financial institutions. In today's episode, we talk about passive index investing, how Andy thinks about risk, the lessons that he has gleaned and taken with him from his time co-founding Benchmark Ventures, one of the top venture firms of all time, and why Wealthfront is a software company doing investment advice and not an investment company doing software, and why that distinction is so important. I think you're going to really enjoy it and hope that you will enjoy more episodes in our back catalog. We have a ton of great guests, including Morgan Housel, Barry Ritholtz, and Chris Hill. You can check all our great finance-related interviews out at goingdeepwithaaron.com/finance, or just scroll through the back catalog in your podcast player. But outside of that, thank you so much for listening. Here is my conversation with Andy Rachleff.
You're listening to Going Deep with Aaron Watson.
So Andy, thank you so much for coming on Going Deep with Aaron Watson. I'm excited to be speaking with you today.
As am I.
I wanted to start off, you've had such a long, successful career. We could talk about venture capital, we could talk about Silicon Valley, we could talk about all these other things, but I really wanted to hone in on your current company, Wealthfront, for today's interview. And in doing some of the research, listening to some of the previous interviews you've done, one thing that you've stressed is that Wealthfront is a software company doing investing, not an investing company doing software. So I'd like to start off by just understanding and unpacking a little bit more why that's such an important distinction for you and why you think that gives you an advantage relative to some of the other players in this space.
Okay. Well, I started the company because I wanted to do a social good. I wanted to democratize access to sophisticated, initially investment management and ultimately financial advice. The problem with the investment industry is that the highest quality services are only made available to the wealthiest people because they have very, very high minimums. Over my years as a venture capitalist, I recruited many people to my portfolio companies who went on to financial success, and they would often come to me for investment advice, and I always felt horrible that I couldn't tell them to do what I do, because even though they'd made $1 or $5 million, they still couldn't afford access to the best investment products or services. Well, the reason that the minimums are so high is because they're people intensive, and the people that you need to access are paid really, really high salaries or compensation. The only way that one could bring down the cost of high quality investing is through software, because most people don't realize this, but really high quality financial planning and investment management is just a series of routine tasks. We've been led to believe that they're not in order to justify the fees that people charge, but in reality, they're really, really routine tasks, and computers are much better at routine tasks than people are. If you want to attract the best people to build that software, the best engineers, you need to create a fantastic working environment for them. And most engineers are not crazy about Wall Street and want nothing to do with financial services. So in order to solve the problem, we needed to create an environment that did not feel at all like a financial services business. And if you walk into the offices of Wealthfront, you would have no idea that you were in a financial services company, because We try not to hire from that world. There's not that much discussion of it. The only people that we hire with financial backgrounds are the investment research people that we need to conceive the products. They're all PhDs from elite schools. And the people who need to be licensed because we're a regulated business. And fortunately, that's a very small percentage of our company.
Yeah, and on that, smart finance side of the business, you have Bert Malkiel. He wrote A Random Walk Down Wall Street, one of the most popular finance and investing books that's out there. Can you talk about getting him on board? That was one of the first finance books that I ever read. It had a huge impact on me, but was it an easy pitch? This seems very closely aligned with his belief in how the average investor can be successful in the market.
So you're right. About 42 years ago, Bert was literally the first person to point out how hard it is to outperform the stock market. Almost everybody thinks they can, but even a very small percentage of professional investors are able to consistently outperform the market. So he published his book, A Random Walk Down Wall Street, which made the case and presented data as to why you would be better off just investing in an index of stocks or a combination of indexes than you would trying to select individual securities. Well, I met Bert through a common friend, a former colleague of his from Princeton, and Bert was immediately interested because he saw in Wealthfront the opportunity to personalize the advice that he had been giving for almost 40 years. And that was, you can't outperform the market, so you shouldn't try. Rather, you should just invest in a portfolio of index funds and focus on the things that you do have control over. And they are diversifying to eliminate risk, minimizing your fees, and minimizing your taxes. And that's exactly what we did. So the problem with a book is it has to be one size fits all because you're writing for one audience. But with personalized software like Wealthfront's, Bert can offer even better advice on his mission to get people to invest better. So it was actually a very, very quick courtship.
With any sort of financial company or financial product, it always seems like education can be something of a tough hurdle in terms of educating the general public on what you're offering, why you're different. There's a lot of these kind of big brand names, and the average person doesn't necessarily know how or if there is differentiation between them. And you talked about Burton being an early advocate for the low-fee passive kind of approach. Jack Bogle was another early proponent of that. He started Vanguard, Fidelity, Schwab, all these other players are rushing in with the low fee solutions.
I wouldn't say Fidelity is rushing in with low fees. Maybe okay. Some of the others. I wouldn't say Fidelity is.
That's fair. Can you talk about the challenge of educating the market on your difference in terms of the guidance and the other services that you're providing that differentiates you from those providers?
Sure. The biggest challenge a startup faces is it cannot afford to educate. Startups have to preach to the converted. So we can't convince people of the merit of our approach. We have to rely on others. And fortunately, people like Vanguard or companies like Vanguard are doing a superb job of it. Passive investing in index funds rather than attempting to outperform the market, has been gaining tremendous share over the last 10 years. So that message is getting out. Vanguard is doing a superb job of it, and we're relying on Vanguard and others continuing to foment the interest around passive investing. Now, when it comes to how we differ from other people, that can be more challenging. Fortunately, there aren't very many players in the automated advisor space, and no one is attempting to automate financial planning, investment management, and personal banking. So our strategy from the very beginning was to take all of the services that are traditionally only available through private wealth managers. Those are the highest end financial advisors that only serve clients with minimum accounts of $5 to $15 million. Automate everything they do in software and deliver them to the masses at much, much lower minimums, as low as $500. So reducing the minimum is even more important than reducing the fee, even though our fee is a quarter of what the industry average financial advisor charges. So we believe that because we're the only automated advisor that's focused solely on delivering our services through software, that there is a very significant difference in terms of the wide range of services that we offer. Other people claim to do what we do, but they don't come close in terms of minimizing taxes and other investment features. But it wasn't until we automated financial planning and all of the other players started to hire traditional financial planners that the difference between what we do and what others do became far more obvious. That others are taking a hybrid approach of trying to marry software with an advisor or a planner, and we're trying to deliver everything through software, which we think appeals to a younger audience that prefers not to talk to people.
That is another thing in my research that I've heard you say before and was really interesting to me. You've said that clients, in surveys and other research you guys have done, the young millennial generation says we pay you not to talk to us.
Right.
And I'm really curious there because that takes me down so many different routes in terms of the role of a financial planner or a financial advisor. And one of the financial advisor's jobs is to protect you from bad ideas, whether that's, I heard about this ICO or this cryptocurrency, or my buddy's trying to put money into a weed startup or something like that. Like, what do you have in place do you think about that? Like how protecting people from themselves, basically?
I think that's absolute bullshit. So forgive me, but I think that's absolute bullshit because they're not effective at doing that. Now, keep in mind that in order to access a traditional financial advisor, you typically need at least $1 million to open an account. The vast majority of young people cannot afford those minimums. So we're trying to serve people who are under 40, who want to delegate the management of their portfolios, who want financial planning, but can't afford the minimum of $1 million. So putting aside, even if a financial advisor were good at protecting you from yourself, the vast majority of people can't afford access to that person.
Gotcha. I know that you have exposure to this demographic that you're going after because you're also lecturing students at Stanford Business School, which boggles my mind that you can be running the company and lecturing, and I don't know how you manage your schedule to do that.
Either do I.
What do you learn from that? I know, just in different coaching and other things that I do, it's not a one-way educational experience. You also learn a lot by being a teacher and working with other young, bright minds. What are you learning through teaching at Stanford Business School that you're bringing back to your business?
I'm not sure that I'm learning things, all that many things that I'm bringing back to the business. I teach a course at Stanford Graduate School of Business on the importance of product market fit to the success of a startup. I think that product market fit trumps everything else. It doesn't matter how good of an executive you are. If the dogs don't want to eat your dog food, you're not going to succeed. And so a number of years ago, I coined this term, product market fit. I've been teaching this class on the subject for about 10 years. And not only do I have great students in my class, but we have amazing guests because we use the case method. We present a dilemma that an actual company faced in the area of product market fit. And the students try to come up with how they would address the dilemma. And then we have the protagonist from the case come in and actually address it. So people like Reed Hastings from Netflix and Erwin Jacobs from Qualcomm come in and talk about the challenges they face in their business. And often through those discussions, I'll come up with a more succinct way of describing the challenge. And then I can apply those more succinct statements to doing a better job of leading the employees at Wealthfront by providing better context.
Gotcha. When you were starting off with Wealthfront, were there any particular business models or previous startups that you looked to that you felt were really had successfully accomplished or were modeling what you were trying to with Wealthfront?
Sure. The original instantiation of Wealthfront was a marketplace. It was a marketplace of investment managers. And the challenge with a marketplace is you have buyers and sellers. How do you get the buyer if you don't have the seller? How do you get the seller if you don't have the buyer? It's a classic chicken and egg problem. So I had used some techniques that I had learned from a number of the successful investments we had made in marketplace businesses at Benchmark. I believe Benchmark has more successful marketplace portfolio companies than anybody in the venture capital business. Unfortunately, we weren't able to make that business work, but out of the ashes of that came the idea for Wealthfront. We talked to people who didn't want to use the old service, and they told us very consistently that I would prefer that you manage all of my money adequately and inexpensively than a portion of it superbly, which is what we were doing before. So that was a pretty easy pivot because it required far less software to implement than what we were doing.
That makes sense. In terms of recruiting and bringing in the technical talent to be dominant from a software perspective relative to these other competitors, what have you learned from advising companies with Benchmark or just in your experience of collecting the talent to execute on the vision that you had for the company?
Well, first and foremost, I think you need to have a vision and a mission that people believe in. I think it's far more interesting to join a missionary company than a mercenary company. So we, from the beginning, have had this desire to democratize access to sophisticated financial advice. That excites some people, it doesn't excite others. But the people that it excites, it really excites. So having a mission that people can get excited about is the first step. And then engineers want to address challenging problems, and we had a number of challenging problems in order to deliver our service. So it's really important to articulate how the engineer is going to be challenged. Not just the engineer, I mean every function, but engineering especially.
When you are creating this missionary type of business and you have very clear vision for what you want to fix and how it's going to go, there's kind of two opposite schools of thought here. The background in venture capital, there's kind of a reality of the power law rule. We're placing our bets on X amount of companies, maybe a quarter of them really have a nice payoff. Some of them are going to fail, and that's kind of par for the course. Whereas at the opposite end, this very low risk passive investing strategy that Burton is a proponent of is very much about minimizing your losses, minimizing the opportunities for that really bad loss, and kind of making slow and steady progress along the way. When you embarked on this personally, with all the success that you'd accomplished and this vision that you had for really trying to fix something in the world that you saw as broken, did you see it more as, very aware of the probability of failure that could come with such a project? Or did you see it more as a slow, steady slog that you were completely committed to? How did you think about risk as you entered into this?
Well, nothing ventured, nothing gained. You can't make a really high return unless you take a lot of risk. And I think in order to get a really big outcome, you have to pursue something that is highly non-consensus. My investment idol is a guy named Howard Marks, who founded a firm called Oaktree Capital, which is the premier distressed debt investment firm in the world. And Howard is as well known for his quarterly letter to his investors as he is for his fantastic returns. I just adore the man. I've had the good fortune to work with him on the Penn Board of Trustees. Well, all of Howard's quarterly letters are built on the same framework. He believes that the investment business can be described with a 2x2 matrix. Now, I also believe this framework can be applied to entrepreneurship as well. But Howard applied it to investing. And on one side, so one dimension of the matrix is you can either be right or wrong. And on the other dimension, you can either be consensus or non-consensus. Now, clearly, if you're wrong, you don't make money. But what most people don't realize is if you're right in consensus, you don't earn above market returns. The only way to earn above market returns is to be right in non-consensus. The problem is that's really, really hard to do. You have to have tremendous knowledge of your domain, which means you have to be awfully authentic to it. And that is a much riskier strategy than doing what's right in consensus. So at Benchmark, if we felt like something fit into the right and consensus quadrant, we would not invest in it, even if we liked the entrepreneur a lot, because we didn't think that could turn into a very significant business. You might be able to sell the company for $20 to $50 million, but that doesn't generate venture returns. So if I were going to start a company, I wasn't going to waste my time on something that didn't have the opportunity to be very, very big. And when we started, the idea of people trusting their money to be managed exclusively by software was a radical idea. Now it's becoming far, far more mainstream today, and I think in the future it'll actually be the dominant way most people have their portfolios invested. But when we started, it was highly non-consensus, and that was a necessary component of any business that I was going to help create.
I really like that. I think that reframes risk in an interesting way. So I appreciate that, and definitely think people should be reading Howard Marks's regular letters. I've read a few of those myself, and they're great, aren't they? They're mind expanding for sure. As we aim towards wrapping up here, Andy, we're going to ask the last two questions, but before that, I want to just see if there's anything that you're hoping to mention today that I didn't give you a chance to.
No, these have been great questions.
Thank you. Well, if people want to learn more about you, Wealthfront, all the great work that you're doing, what digital coordinates can we point people towards?
Well, obviously, you can come to our website at www.wealthfront.com to learn about what we provide. I share my thoughts on data-driven, actionable financial advice in our blog, which you can access from the Wealthfront website or from blog.wealthfront.com, or just Google Wealthfront blog. And then I also tweet at Rachleff, at A Rachleff. It's ARACHLEFF.
Excellent. That will be linked to in the show notes at goingdeepwithaaron.com/podcast. You'll be able to find all those links and more about Andy there.
By the way, if your clients are interested in opening an account, if they use the following link, they'll get an additional $5,000 managed for free, for a total of their first $15,000 will be managed for free. You typically get $10,000 managed for free. With this link, you get an additional $5,000. So if they go to wealthfront.com/Andy and sign up that way, they'll get $15,000 managed for free.
That's awesome. We'll be sure to link that as well. But before I ask you to issue the personal challenge to the audience, Andy, we've talked about Random Walk Down Wall Street. We've talked about Howard Marks' letters. Are there any other finance-related books that have been particularly impactful for you during your career?
Not really. The book that's actually been most impactful to me has been The Innovator's Dilemma and its sister book, The Innovator's Solution. These two books were written by Clay Christensen, the creator of disruption theory. Now, the term disruption has become very commonly used these days about technology companies, but unfortunately it's terribly misused. I think that Clay's original theory about disruption is worthy of a Nobel Prize, and it has completely changed the way that I think about business. And the Innovator's Dilemma is written from the perspective of the incumbent facing a new entrant, and the Innovator's Solution is written from the perspective of the startup attempting to disrupt an incumbent. And I think these two books are just unbelievable for anyone thinking about doing a startup. It can be valuable in evaluating an investment in a technology business. But investment books, the best one I know of is Bert's A Random Walk Down Wall Street.
Certainly. And another thing with those books is it passes that test of holding up over the years and continuing to be a valuable resource well beyond its initial release. So definitely recommend that for people as well. We'll link to that. But as we do at the end of every episode, Andy, I like it when we can leave our audience with a personal challenge from the guest. So I want to give you the mic one last time to issue a personal challenge.
Well, I think that unfortunately, young people are often sitting on the sidelines when it comes to investing. And if you keep all of your money in cash, then your purchasing power is going to decline over time. You need to make the leap to invest. And I think the best way to do that is to invest in a diversified portfolio of index funds. Even Warren Buffett last year came out and said that's what you should do. Now, there are a variety of ways that one can do that, but I think it's really, of which Wealthfront is one, but I think it's really important that after you set aside the money for your emergency fund, set aside at least 6 months worth of your expense rate in a very low risk account like a savings account. Any money you save over that should be invested in a diversified portfolio of low-cost index funds.
I like that advice. The one pushback, just being a millennial myself, I have a lot of peers with a lot of student loan debt. And one of the biggest pushbacks I hear is I can't start investing yet. I'm still paying off my student loans. We've had a couple guests with a couple different perspectives on that. How do you think about prioritizing paying down debt versus starting to invest?
Well, it all depends what the interest rate is. So paying down debt is the equivalent of a risk-free return. So if you have a student loan that charges 6% and you pay that off, it's like earning a guaranteed 6% return. That's an equivalent return from what you would get from a diversified portfolio, which is going to have a lot more risk. It's going to have at least some risk. So I think if your interest rate is 5 or 6% and above, it's a no-brainer to pay off that student loan. If your interest rate is 4%, then I'm not so sure that's the best decision right now. But if your interest rate's 5% or above, then absolutely pay off that student debt first.
Excellent advice, and thank you so much for sharing your wisdom, sharing your time with us, Andy. Excited about the great work you're doing, making these investment advice and services available to the masses at an affordable cost. We just went deep with Andy Rachleff. Hope everyone out there has a fantastic day. Hey, thank you so much for listening. Please hit subscribe if you've not already done so. Check out that offer from Andy to get an additional $5,000 off when you start investing with Wealthfront. That link will be located at goingdeepwithaaron.com/podcast, along with the show notes for every episode of the show. Coming on down the pipe, we have two really exciting interviews. One with Christian Simmons, the founder of Pennsylvania Libations. He is breaking through the bureaucratic and legal mess that is Pennsylvania's liquor laws to provide an affordable direct-to-consumer solution located right here in Pittsburgh. We've also got Kim Scott, the author of Radical Candor, who's learned under Sheryl Sandberg and taught management at Apple. Wrote a book called Radical Candor, a new way to think about managing your team and your company. You will learn a lot from both of those conversations, so make sure you are subscribed to Going Deep with Aaron Watson. Thank you.
Thanks for listening. Connect with Aaron on Twitter and Instagram at AaronWatson59.